All right, we'll go ahead and just start introducing our speakers today. We have Bharat Ramamurti, Senior Advisor for Economic Strategy at the Economic Liberties Project and former Deputy Director of the National Economic Council. We have Jen Harris, Economy and Society Initiative Director at the Hewlett Foundation and former Senior Biden Administration official. Kitty Richards, Senior Fellow at the Groundwork Collaborative and former Treasury official. And Skanda Amarnath, Executive Director of Employ America and former Fed economist. So we'll start off with a few words from each of our speakers, and then we'll open it up for questions at the end. And we'll kick it off with Bharat.
Thanks very much. Thanks everyone for joining. I will keep it very brief so we can get to the other speakers and to questions. It's good to start with the basics, of course. The Fed has a dual mandate of maintaining price stability and supporting maximum employment. As of today, the data strongly suggests that the risks to employment are much more severe than the risks to price stability. Unemployment remains fairly low by historical standards, of course, but it has risen considerably in the last few months. Initial unemployment claims have been trending upwards. Job openings have been trending down. Wage growth has been slowing. All of that data points to softening in the labor market. Meanwhile, inflation measures are running at or near the Fed's target, with a significant amount of disinflation likely in the pipeline. So in light of all of that data, the Fed should begin cutting rates at the meeting this week. Any further delay in cutting rates risks unnecessary damage to the job market and to American workers and to key investments that we have to make as a country. If the Fed does not take that path, in my view, it must cut in September and consider a larger cut of 50 basis points if the data continues to trend as it has in recent months. So with that, I will turn it over to Jen.
Thanks, Bharat, and thanks for joining. Unsurprisingly, no daylight between myself and Bharat on the kind of bottom line of cutting now for all the reasons that he mentioned. I elaborated on those reasons in a piece out today in the Times op-ed section, which you can find. But maybe I will use my 120 seconds here to kind of elaborate on two of the most damaging aspects of the Fed's current policy, which paradoxically are actually undermining the Fed's own fight against inflation. When you look at where the bulk of continued inflationary pressure has been coming from for, I'll leave maybe Skanda to put a, handicap that with the time duration. I would say at least over the last, 18 months, perhaps. And certainly, I remember a fair bit of energy price pressures in kind of spring of 22, as far back as that. You're talking about housing and energy prices is still doing a whole lot of the work here. And what's really unhelpful for housing, sort of new housing starts, 5.5% interest rates, giving mortgage, rise to mortgage rates where they are. And in the fix, to me, these things belong in a broader category of more supply side inflationary drivers of the sort that I think we're actually in for a lot more of looking out into the next decade or so. It's climate-induced crop failures. It's Houthi rebels droning major maritime choke points. It's the evergreen problem we've had for a good while now on housing, and it's the kind of like continued volatility in oil and gas prices, to name just a handful, and rising, using the blunt tool of rate hikes has always been a kind of attenuated and overly blunt instrument for those kinds of inflationary pressures. So I would argue for really building a set of tools that are much more responsive to those kinds of pain points. And I think it looks like, adjust sort of rates that are more bespoke, where if you can find a way to provide discounted financing costs for at least energy and housing, even if you feel the need to keep interest rates roughly where they are for the rest of the economy. The rest of the economy might be able to manage well enough in these kinds of moments. I think there's a strong argument for figuring out a way to be concessional on those two pieces. And this is something that other central banks around the world have figured out how to do on various issues. I realize it still remains exotic for our community of Fed watchers, but increasingly necessary. So I would put that on the table. And I think the other piece that really needs building out is much more and more creative use of buffer stocks, especially in areas, sort of sectors that tend to straddle a whole bunch of different supply chains. So thinking about critical minerals as an example, alongside, some of the commodity type reserves and things like the SPR that we've had for a while. So I'll leave it at that, and we'll pass it to, I've forgotten who was supposed to pass it to. Kitty, is it you?
Yes, Kitty.
Thanks.
Hi, everyone. I think I will give a simpler take building on all of the great things that have been said before me. It's pretty clear at this point that the Fed's extraordinarily aggressive interest rate hikes starting in 2022 were not the primary driver of the disinflation that we saw, because as Jen has pointed out, the primary driver of the really big spike in inflation that we saw all across the world was supply chain issues, mostly stemming from the COVID-19 pandemic. And it took longer than expected for some of those things to work their way through the system. But I don't think that the data at this point is consistent with a story of interest rate policy bringing down inflation and needing to stay the course now. And so once you step away from that, I think we really just need to do a basic cost benefit analysis, and the Fed needs to do a basic cost benefit analysis that, in addition to the risks to the labor market that Bharat was talking about, there are really significant costs to American families and to future cost of living, as Jen was pointing out, to high interest rates. And it's really not clear what benefit they are creating. As Jen pointed out, high interest rates are actually causing problems in the housing market that will lead to lower supply in the future, which will lead to higher prices, and causing problems in the financing of the clean energy transition, which also, if we don't finance that, we'll be suffering from more of these supply chain problems in the future and just relying on expensive, dirty energy for longer. But additionally, at this point, the Fed's interest rate policy is actually contributing more to the cost of living problems that American families are facing than inflation. And, that's largely because most American families do not buy houses in cash, and they do not buy cars in cash, and they put some significant amount of consumer spending, at least temporarily, on credit. And the cost of borrowing money has gone up so dramatically over the past 2 years that it has really put items that would be affordable given the wage gains that American workers have seen over the course of this recovery out of reach because they can't afford the money to finance them. And that is an enormous problem for American families, American workers. And in fact, the Fed, by keeping interest rates high, is essentially taxing away the inflation adjusted wage gains that American workers are seeing. And there's nowhere that this is more apparent than the housing market, where mortgage interest rates have doubled. That means that combined with increases in home prices, we've seen the mortgage payment, the monthly payment on a typical home, increase by more than 50% over the last 2 years. And that's put homeownership out of reach. Anyone who had any floating rate debt is now making much, much larger payments on that debt. That's directly contributing to, we're seeing rises in delinquency rates. This is a huge problem, and it's locking people out of home ownership in a way that keeps them in the rental market. So rental prices are spiking. And that's a huge part of the family budget. But it's also true if you just think about transportation. People have had a lot of difficulty purchasing cars. Part of that is certainly that there was a big spike in especially used car prices during the pandemic. And we had a chip shortage, which the Biden-Harris administration has moved to deal with. But now the cost of financing a car has risen by much, much more than the price of cars have risen over the last couple of years. And those costs are things that the Fed can deal with right now. They don't have to think about a balance of risks. They don't have to worry about deflation. They can just bring down costs for American families, which at this point, I think there's very little reason to believe that a significant cut in rates, I would go further than 50 basis points. If you think that the Fed went too high and has held too high too long, they can cut more aggressively as well. A significant cut in rates would actually bring costs down for families very quickly. And I don't think that there's any reason to believe that it would lead to an inflationary spiral. Skanda, I don't know if you have anything you'd like to say.
Thanks, Kitty. Look, so by all sort of predictive accounts of what will happen on Wednesday, the Fed is not inclined to cut rates in the manner that I think, for all my fellow panelists and myself included, would think would be actually quite wise to do. And I think the best way to think about it is it's a risk management game. The Fed right now is willing to take the risk that nothing bad is really happening in the economy. And maybe on some sort of, in the baseline scenario, in most states of the world, that might be true. But there are risks right now that we can see, and it's pretty obvious in terms of the unemployment rate rising is something you typically don't bet against. You don't bet against the unemployment rate rising and not think that's associated with some additional recession risk. There are some good reasons why the unemployment rate might be rising for reasons that are not so nefarious. Labor force participation is rising. There are a lot of good things going on in the labor market. But whenever that's happening, it's a moment to pause and to ask yourself, let's say this is actually going up for the wrong reasons. And let's say on Friday, if we find out that the unemployment rate is going up for some reasons other than just higher labor force participation, then what? Then the Fed is behind the curve even further than that. And then the Fed is basically in a position where they have to play catch up. And they're playing catch up already because they calibrated their interest rate policy back in the summer of 2023 to 5.5% interest rates, with the assumption that we'd be stuck around 3.5%, 4% on core inflation. We're down to 2.6%. And of that remaining 0.6% above the Fed's target, more than half of that, roughly 2/3 of that, is about housing and rent inflation, which has its own challenges associated with it. As it stands now, we're seeing housing starts and building permits largely get hollowed out. We're seeing pretty weak housing numbers in terms of construction because ultimately credit, while it's presumed to be this sort of demand side channel, it's cooling down the housing market, it's also cooling down building. It's also having a supply side effect. And this is a big problem for how the Fed is actually going to manage inflation over the next few years, right? There are a lot of lags associated with current rent inflation. Definitely a lot of Americans have faced higher rents because supply is so inelastic and scarce. But that problem is not going to go away in the next 2-3 years, so long as the Fed is going to maintain this restrictive policy stance. So there's some paradoxical effects happening now that probably don't comport with the textbook narrative. And if the Fed is really being led by the data, whether you're taking that more unorthodox perspective, or just a simple fact that inflation's come down a lot more than the Fed expected, if you rewind to, let's say, 12 months ago, 18 months ago, and then you stack on the risk management considerations, the case for going sooner is pretty strong. I don't think this is actually a pretty outlandish view. If you think about where Greg Ip of Wall Street Journal had a great column on how the case for going in July is pretty strong, and just saying, well, it's only 25 basis points. Well, they can always wait another 6 weeks. Well, that's more time in which current interest rate policy will be misaligned from where it should be. And that misalignment could grow quite drastically if we find out on Friday that the labor market may be on shakier ground than we first assume. So if we put those things all together, I think it's just a really gratuitous risk the Fed is taking, or is very likely to take on Wednesday, by not cutting rates in July. And I think, to Bharat's point, the case for going faster, or at least upfront in terms of interest rate cuts, becomes more compelling because the Fed will find itself with policy rate settings that are just not aligned to where the economy really is.
Thank you so much, Skanda, and all of our speakers. We'll open it up to questions. If you have a question, please just raise your hand and I will unmute you. If you could introduce yourself and ask your question. Yes, Nick, go ahead.
Great. Thank you all for doing this. Kitty or Jen, I think either or both of you had said that the primary driver of this was supply chain issues and that there were other central banks that have managed the trade-offs better. And I was just wondering, which ones do you think have done a better job? In Europe, for example, which had a much bigger supply side shock from the Ukraine war, they raised rates from minus 50 basis points to 4%. And so I'm just curious, which central banks you pointed to, some that have done a better job. I wonder which ones you think the Fed should emulate here.
Sure, I'm happy to start, and Kitty, please pile on. In referencing other central banks, was really talking about a narrower point around the way that certain central banks have figured out a way of designing programs to ease financial conditions for certain pockets of the economy, right? Kind of some amount of rate differentiation to kind of solve for certain pain points within their existing mandates. So the point is, the point I'm trying to make is, like, I'm not asking the Fed to get woke on climate. I'm not trying to, kind of inject any climate equities into their existing mandate. I'm asking them, to inhabit just the kind of modicum of even a medium, let alone longer term view of what, price stabilization would really entail, and realize that probably for both of our, Nick, I don't know how old you are, but at least for my entire professional lifetime, you've had, the Fed essentially asking fiscal policy to move. I've kind of like deployed all of the creative arts and all the bullets in the kind of Fed holster, and there's very little that the Fed can do, and fiscal policy needs to move is, sort of a standard refrain we have heard since 2010. And fiscal policy has moved, and you don't get to pick your political windows in Washington. And right now, frankly, the Fed is just, throwing sand in the largest fiscal window we've had for, not for nothing, a set of investments that would be price stabilizing over the medium term, and the switch from the kind of price volatility you've seen, including in this bout of inflation. Again, I'm thinking back into the kind of like spring of, I remember being most acute in the kind of, what was that? Kind of fall, winter of 21 into the spring of 22, when OPEC was being extraordinarily unhelpful, and you had like bizarre outages and refining capacity, all lending to like a really high oil prices, which was profoundly unhelpful. You've seen kind of lower burn, upticks in gas prices as well, stoking inflation, in the past 10 months or so. All of which leads me to believe that, if the Fed could find its way to something neutral or better, and the moment we have right now, where fiscal policy is encouraging a switch of the grid towards more renewable, less price volatile sources of energy, that would lend to price stabilization and taking care of one of the largest inflationary channels we have had historically. And I see that as firmly foursquare within their mandate. So, I think people like Martin Sandbo and others have written about the ways in which other banks, like I just named three, I'll add another. I think the Bank of China has actually done this for certain clean energy investments, figured out a way of easing financial conditions for certain pockets. It's not just energy that I'm on a soapbox about. I would add housing as well. And I think that this can be temporary. I'm only really looking for, 36 months of some kind of concessional sleeve for these load bearing pieces of inflationary pressures that we still have. So I don't know if that's helpful and clarifying. That's what I would most like to see here. And I realize that this is, you know, not something that's really seen as within the window right now in our existing Fed conversations.
I also just want to, you know, when we're thinking about what central banks can and cannot do, it is the case that interest rate policy is incredibly blunt, and that in many cases, fiscal policy is a more fine-grained tool for dealing with the really complex things that underlie the big macroeconomic picture. I think that in a strange way, however, that has allowed some abdication of what the central bank is currently doing, which is holding interest rates at a level that they themselves think is restrictive. And as Skanda pointed out, if they are looking at their own data and their own calibration and their own projections from last year, they should be cutting rates already. And I think we really need to pose the question more aggressively. Do central bankers, especially in the United States, really think that cutting interest rates will lead to a resumption of out of control spiraling inflation? Because that is the risk that they are trying to manage when they talk about maintaining interest rates at current levels until they are confident that inflation is headed back toward the 2% target. And if they do not genuinely believe that a drop to whatever they believe the normal long-term neutral interest rate is will kick off renewed inflation, they need to compare that to the really serious problems, the risks that Skanda and Bharat were talking about. They need to think about the risks to the labor market, the risks to the economy, but also the direct costs today to workers and families and the energy transition and housing production, because that is in fact squarely within their power. And the Fed actually has a triple mandate. One of their mandates is appropriate long-term interest rates. And I think the Fed, if they really look at the data and ask, do we need to have restrictive policy? Or even better, is this restrictive policy actually helping to deal with prices? And if not, why are we causing all of this harm?
One thing I can also just tack on here in terms of there's obviously some supply side incidents and there's some demand side incidents going on in terms of what the Fed's doing. In terms of restricting policy, it has some effects on the demand side. It has some effects on the supply side. How much of a demand side effect do you want to see? We've seen the labor markets substantially cool, I'd say, in terms of wage growth. It's marginally higher than where we were pre-pandemic, but especially in accounting for productivity, it seems to be in a pretty healthy place. We're seeing workers finally see some real wage gains after a period of real wage losses. And so there is a recovery underway there. Obviously depends from worker to worker, household to household. But we don't want to see labor markets cool to the point where they get back in the freezer. And that momentum itself, we're in a pretty healthy equilibrium between wage growth and where job growth is. We don't really want to see job growth slower, especially if it's because it's driven right now by population growth. I think this is a place where the Fed should be more eager to pivot, take away some of their language around, hey, we have the luxury of time. What's the hurry? The hurry is that things can change faster than you realize, right? And then life comes at you fast is maybe the simplest way to put it. And I think that with that misalignment in place, you have some supply side considerations, but also to the extent you were expecting demand to cool, I don't think you really would want to see demand cool substantially further from here because it starts to raise more asymmetric risks to the downside. It's just talking about recession risks. When recessions happen, they don't just happen slowly. It's not a slow burn, and that's the bigger risk around this stuff that the Fed's just taking at a time when there are supply side costs the Fed has kind of persistently underappreciated associated with restrictive policy, and we're starting to see more of that crop up, especially in housing.
Skanda, can you make your point about the kind of like historical tight fit between full employment and productivity?
Oh, I mean, I think this is a point that's becoming more apparent in this episode, just as it was in the late 90s. And very briefly, I guess if we look in retrospect to 2019, where productivity growth right now, we're going to find out later this week, the official productivity data for Q2. We basically know it from what we learned in the GDP release. It's pretty damn good. It's pretty solid. And excuse my language, but it was pretty solid as far as 1.6, 1.7% likely on a quarter basis. More impressively, it's above 2%, maybe 2.5% year over year. These are well above trend. We were doing about 1.2, 1.4% before the pandemic. Especially if we take sort of even a generous timeline, it's 1.4% was the norm. And we were slowing down for much of the 2010s. So we're starting to see labor productivity pick up. There's some good reasons to think that's tied to full employment. And so far as now more people are trained into their jobs, more people have been hired back and hired back quickly, as opposed to a decade of pretty stagnant labor market outcomes. If we look back to the early 2010s and how long it took to crawl our way out of it. And I think a lot of that also comes back to how workers have had the option to be able to switch into better jobs. If you can switch into more productive employment, if you can be trained into those jobs sooner, faster, the dividends of that come quicker. And so we're starting to see that show up in on the supply side in a way that I think a lot of people did not predict, and is pretty exciting. Something to watch for Thursday.
Yeah, I think to elaborate on that, there's this perverse thing when you're talking about monetary policy. We start talking about wage growth as if it's a bad thing. And you hear this in the Fed, in Jerome Powell's statements, talking about being pleased to see wage growth slowing. This portends good things for inflation. We've spent a very, very long time in this country in an equilibrium of low wages and wages not keeping pace with productivity growth. And we've also at the same time seen relatively stagnant productivity growth. And I think, to Skanda's point, having a tight labor market with wage growth and empowerment for workers and the ability for workers to change jobs, to know that there's another job for them, it causes companies to invest in their workforce and see them as less disposable. It allows for individuals to invest in their own productivity. And we can see rapidly rising wages alongside rising productivity growth without any increase in inflation. And it's another place where the really simplified story of high demand, too much money chasing too many goods and services really breaks down. And we're seeing this with people being drawn into the labor force, right? We don't actually have a fixed pool of labor. We have a whole bunch of folks who, for the right wage and the right working conditions, are happy to come to work, and it makes sense for them. And they're coming in and adding productivity to the economy and adding to growth. So I think it's another place where the very, very simple rules often talked about in the monetary policy debate are missing the more granular stuff that's going on in the economy.
All right, and we have another question from Casey Quinlan at States Newsroom. You spoke about signs that the labor market is being put at risk by the Fed's interest rate decisions. Likely decision on Wednesday. What signs other than the unemployment rate and number of jobs added will you be looking for in the jobs report to understand whether the labor market is cooling too quickly?
I'm happy to take that. I think the number I'm watching for Friday is it's something you have to kind of look through the details of, but the prime age employment rate, which adjusts for labor force participation and adjusts for the aging of the population, that has not been declining, unlike the unemployment rate, which has been increasing, or just take the inverse. But you can see a flatlining there. And so we've been stuck around 80.8% for a while. It's actually a little bit lower than it was last year. So there's been a a flatlining there, and even flatlining is itself a concern because it tells you job growth is slowing down relative to population growth. And when that happens, that tends to be like, look, not all slowdowns foretell a recession, but all recessions succeed a slowdown mechanically. And so it's the necessary condition. And I would like to see the prime age employment rate actually show some gains. I think over time, if the economy is on track, we should see probably slow and steady gains from here after rapid recovering gains earlier in this expansion. But if we see more flatlining or worse, a contraction, I think it's a sign that there is more signal in the unemployment rate than a lot of people have been willing to acknowledge. And I'd say the Fed, and the fact that they have basically locked themselves into the prospect of keeping rates steady in July, despite the fact that the unemployment rate is going up, and despite the fact that, as I said, that there are also signs, even if it's not an outright contraction in the labor market, that we're seeing a pretty visible slowdown in some of these other more refined and nerdy metrics. The Fed's running some high risk here. I think that that's the best way to put it. I would not be comfortable with that kind of risk the Fed is showing itself to be quite comfortable taking going into this July FOMC meeting.
Yeah, I would just add to Skanda that when we were in the administration, the Thursday release of continuing and initial unemployment claims is always an important marker. Obviously, we don't get real-time data on the labor market, but that's pretty much the closest thing that we get because we get it weekly. And it doesn't provide you total insight on what's going on in the labor market, but it's a pretty good rough metric about the trend. And so that when you see initial claims rising, as you've seen over the last few months, I think that's a pretty good sign that the labor market is softening. I mean, look, just the big picture in all of this for me is that I'm sure everybody on this call and many people out there have quibbles with how the Fed and sort of the fiscal authorities in the United States have handled this post-COVID recession period. But I think that if you zoom out, objectively speaking, fiscal and monetary policy has worked to create an extraordinarily strong recovery, and the finish line is in sight. And it would be tragic, I think is the word I would use, for the Fed to stumble and fall with 0.1 miles left in the marathon, which is what I think they would be doing if they don't start cutting.
I couldn't agree more. Casey, to your specific point about what to watch on Friday, I would add, do watch the unemployment rate. And one piece of that is it doesn't have to tick up for it to be a continuing sign of softening in the labor market. The unemployment rate has already risen significantly. And I believe that if it stays at 4.1, because of the moving average, the Claudius sum rule will actually be triggered. But the way to think, I guess what I'm trying to say in a less wonky way is that we have seen softening in the labor market, and the unemployment rate, I think, is the big piece of evidence there, though there are other pieces. And there's some hope that perhaps the unemployment rate ticks back down to 4. If it does not, if it remains steady at 4.1, we should see that as signs that that is in fact real softening in the labor market, not just a statistical anomaly. And so I think there can be, it's easy to focus on the change, but it's worth bearing in mind how much of an increase we've already seen over the last few months.
Okay, do we have any other questions? All right, well, thank you everybody for joining. If you have any follow-up questions or would like to speak to any of today's speakers, you can email esb@skdknick.com. Just put it in the chat. Thanks to our speakers and thanks to our audience for attending. Bye.